Let's talk about one of the biggest financial commitments most people will ever make, a mortgage. You've probably heard the number of a percent rate, a 6% rate, and you know it's important. But do you truly understand what's happening every single month when you make that payment? Most people don't. They see one number leave their account and assume it's all going toward owning their home. But the reality is far more interesting and, frankly, a bit brutal at the start. Understanding how mortgage interest really works isn't just academic. It's the difference between throwing money away and building wealth efficiently. In this video, we're going to strip away the confusion. We'll explain the fundamental dance between principal and interest, unveil the magic and sometimes misery of the amortization schedule, and show you powerful strategies to save literally tens of thousands of dollars over the life of your loan. By the end, you won't just know what an interest rate is, you'll know how to beat it. First, we need to establish the core players in every single mortgage payment: principal and interest. The principal is the actual amount of money you borrowed to buy the house. If you take out a $300,000 loan, that's your starting principal. The interest is the cost you pay to the lender for lending you that money. It's their profit, their fee for the service, and the risk they take. Your monthly mortgage payment is primarily a combination of these two, often abbreviated as P&I. But here's the critical, non-negotiable rule of how they work together. In the early years of your mortgage, the vast majority of your monthly payment goes toward paying the interest, not the principal. This isn't a mistake or a scam. It's the mathematical reality of how loans are structured. Let's use a simple analogy. Imagine the interest is calculated on the outstanding balance of your loan, like a giant snowball of debt. At the very beginning, your snowball is at its biggest, it's the full $300,000. So, the interest charge, which is a percentage of that huge snowball, is also huge. Your fixed monthly payment has to cover that large interest charge first. Whatever is left over and at the start, it's a surprisingly small amount then chips away at the principal snowball itself. This system is called amortization. This brings us to the most important document you probably haven't looked at, the amortization schedule. The standard options are 30-year and 15-year loans. A 15-year loan will have a higher monthly payment because you're paying off the same principal in half the time. But crucially, it also almost always comes with a lower interest rate. The combination of a lower rate and a shorter term dramatically reduces the total interest you pay. Using our example, a 15-year loan at 3.5% would save you over $100,000 in interest compared to the 30-year at 4%. Your monthly payment is higher, but you build equity faster and save a fortune. The term you choose is a trade-off between monthly cash flow and total cost. Given that the system is front-loaded with interest, what can you actually do to fight back? The single most powerful tool you have is making extra payments toward the principal. Even small, consistent extra payments can shave years off your loan and save a staggering amount of money. Why? Because every extra dollar goes directly to shrinking that principal snowball right now. This reduces the balance that future interest is calculated on, creating a compounding savings effect. Let's say you pay an extra $100 per month on that $300,000 for percent loan. You would pay off the loan almost 5 years early and save over $26,000 in interest. The key is you must explicitly instruct your lender that the extra payment is to be applied to the principal, not to next month's interest. Do this in writing. A pro tip: if you get a bi-weekly paycheck, consider splitting your monthly payment in half and paying every 2 weeks. This results in 26 half payments per year, which is 13 full payments, not 12. That one extra payment per year applies entirely to principal and can cut a 30-year loan down by several years. Two other important concepts are points and the difference between interest rate and APR. Points, or discount points, are an upfront fee you can pay to buy down your interest rate. Before we wrap up, a crucial reminder about financial responsibility. A mortgage is powerful leverage. It allows you to own a valuable asset by putting down only a fraction of its cost. But this leverage is a double-edged sword. Taking on a mortgage is a serious, long-term commitment. You must be confident in your stable income and budget for not just the P&I, but also property taxes, insurance, maintenance, and potential HOA fees, often bundled into an escrow payment. Never stretch so far that the monthly payment becomes a source of constant stress. The goal is to use the knowledge of how interest works to structure a smart loan you can afford, and then use strategic extra payments to own your home free and clear faster. This knowledge turns you from a passive borrower into an active manager of your largest debt. So, get your loan details, find an amortization calculator, and run the numbers. See what an extra $50 or $100 a month does. The power to save a small fortune is literally in your hands, one principal payment at a time.